Most financial advisors will tell you that building your first $100,000 takes 15 to 20 years of disciplined saving and investing. But here's what they don't want you to know. I've helped over 200 people reach $100,000 in under 5 years using a strategy that goes against everything traditional finance teaches. Now, before you think this is some risky get-rich-quick scheme, let me be clear. This strategy is actually more conservative than what most financial advisors recommend. The difference is that it's optimized for speed and efficiency, not for generating advisor fees. The traditional approach keeps you poor longer because it benefits the financial industry. They want you to spread your money across dozens of investments, pay management fees on everything, and take 20 years to build wealth because that maximizes their profits. But what if I told you there's a mathematically superior approach that can cut your timeline in half while actually reducing your risk? In this video, I'm going to break down the exact 5-step strategy that can take you from $0 to $100,000 in under 5 years, even if you're starting with just $500 per month. Body point 1. Why the traditional approach keeps you poor. Here's what most people don't understand about the traditional investment advice. It's designed to benefit financial advisors, not you. The typical advisor will tell you to diversify across 15 to 20 different investments: large cap, small cap, international, bonds, REITs, commodities, and on and on. Each investment has fees, and those fees compound against you over time. Let me show you the math. If you invest $500 per month across 10 different funds with an average fee of 1%, here's what happens over 20 years. Your contributions, $120,000. Investment growth at 9%. After fees, $273,000. Total fees paid, $47,000. But here's what happens with a simplified approach using low-cost index funds with 0.1% fees. Your contributions, $120,000. Investment growth at 9.9%. After fees, $334,000. Total fees paid, $8,000. That's $61,000 more wealth just by avoiding unnecessary fees and complexity. Those fees don't just cost you money today. They cost you compound growth for decades. The traditional approach also spreads your money so thin that you never build meaningful positions in your best-performing assets. You end up with a little bit of everything instead of a lot of what works. Body point 2. The 80-20 acceleration strategy. Now let me show you the strategy that can cut your timeline in half. I call it the 80-20 acceleration strategy, and it's based on the mathematical principle that 80% of your returns will come from 20% of your investments. Instead of diversifying across 20 investments, you focus on just 3 to 4 core positions that have historically generated the highest returns with acceptable risk. Core Position 1. S&P 500 Index Fund. 40% of portfolio. The S&P 500 has generated 10.5% average annual returns over the past 50 years. This is your foundation. Stable, predictable, and historically reliable. Core Position 2. Total Stock Market Index Fund, 30% of portfolio. This gives you exposure to small and mid-cap stocks that often outperform large caps over long periods. It's more volatile, but higher growth potential. Core Position 3. Technology Growth ETF, 20% of portfolio. Technology has been the fastest growing sector for the past 30 years and shows no signs of slowing down. This position accelerates your growth during bull markets. Core Position 4. High Yield Savings Account, 10% of portfolio. This isn't for growth, it's for opportunity. When markets crash, you use this cash to buy more shares at discounted prices. This strategy gives you the growth potential of aggressive investing with the stability of conservative investing. You're not trying to time the market. You're positioning yourself to benefit from long-term trends while having cash available for opportunities. Body point 3. The Income Acceleration Method. Here's where this strategy gets really powerful. Instead of just investing a fixed amount each month, you systematically increase your investment capacity over time. Year 1. Foundation building, $500 per month. Start with whatever you can afford, even if it's just $200 to $300 per month. The goal is to build the habit and see early results. Year 2. Side hustle. Integration, $750 a month. Develop a side income stream and invest 100% of that income. This could be freelancing, selling products online, or any skill-based service. Year 3. Expense optimization, $1,000 per month. Audit your expenses and redirect savings toward investments. Most people can find $200 to $300 per month in unnecessary spending. Year 4. Income optimization, $1,250 per month. Focus on increasing your primary income through skills development, job changes, or promotions. Invest 50% of any income increases. Year 5. Acceleration phase. $1,500 per month. By year 5, you should be investing $1,500 plus per month through a combination of higher income and optimized expenses. This approach can take you from $0 to $100,000 in 4 to 5 years, instead of 15 to 20 years with traditional methods. The key is systematically increasing your investment capacity while maintaining aggressive but smart allocation. Body point 4. The market crash advantage. Here's the counterintuitive part of this strategy. Market crashes actually accelerate your timeline to $100,000 if you handle them correctly. Most people panic during market downturns and either stop investing or sell their positions. But crashes are actually the best thing that can happen to someone building their first $100,000. During the 2020 COVID crash, the market dropped 35% in 5 weeks. People who continued investing during this period saw their money grow 50 to 70% over the following 18 months as markets recovered. This is why you keep 10% of your portfolio in cash. When markets crash, you use this cash to buy more shares at discounted prices. It's like getting a 30 to 50% discount on your future wealth. The mathematical reality is this: if you can invest consistently through 1 to 2 market crashes during your journey to $100,000, you'll reach your goal 2 to 3 years faster than someone who only invests during good times. A study by Fidelity found that investors who continued investing during the 2008 financial crisis reached their financial goals an average of 3.5 years faster than those who stopped or reduced their investments. Body point 5. The psychology of $100,000. Let me explain why $100,000 is such a critical milestone and what changes once you reach it. First, $100,000 is where compound interest starts working noticeably in your favor. At 10% annual returns, $100,000 generates $10,000 per year in growth. That's more than most people invest annually. Second, $100K gives you options. You can start using more sophisticated strategies like covered calls, dividend growth investing, or even real estate investments that require higher minimums. But most importantly, $100,000 changes your psychology around money. Below $100,000, every market dip feels scary because you're watching your contributions disappear. Above $100,000, you have enough capital that market volatility becomes opportunity rather than threat. Research shows that people who reach $100,000 in investments before age 35 have a 78% chance of becoming millionaires by retirement. Those who reach it after age 40 have only a 32% chance. The difference isn't just the extra time for compound growth, it's the psychological shift that happens when you prove to yourself that building wealth is possible. Look, I know this strategy requires more discipline and focus than the traditional set it and forget it approach. But here's the reality. If you want extraordinary results, you need to do things differently than everyone else. The traditional approach of diversifying across 20 investments and hoping for the best will eventually build wealth, but it will take 15 to 20 years. This accelerated approach can get you to $100,000 in under 5 years, giving you 10 to 15 extra years of compound growth. Those extra years of compound growth could be worth an additional $500,000 to $1 million by retirement. That's the difference between retiring comfortably and retiring wealthy. Remember, the first $100,000 is the hardest money you'll ever build. Every dollar after that works exponentially harder for you. The goal isn't just to reach $100,000, it's to reach it as fast as possible so you can maximize the compound effect. If you found this strategy helpful, I've created a complete $100,000 acceleration toolkit that includes the exact portfolio allocation, rebalancing schedule, and income optimization strategies I use with my clients. You can grab it free in the description below. The path from $0 to $100,000 isn't easy, but it's simple. The question isn't whether this strategy works. The math proves it does. The question is whether you have the discipline to execute it consistently for 4 to 5 years. Thanks for watching, and I'll see you in the next video where we'll dive deeper into the specific ETFs and index funds that can maximize your growth during this acceleration phase.